affect that.
Sam, mere mortals don't have access to you on a daily basis like we do. Is this just going to confuse people and make less people want to vaccinate? You know, are we going to see a real pushback against people saying, no, actually, I don't want the vaccine?
Well, you have to worry about that, right? Because at the end of the day, if politicians and regulators push this out without truly knowing what the actual efficacy of the vaccine is, then even though you know that it actually is doing something, because there were no severe cases in the vaccinated group, you do have that issue of people thinking, well, has that question been resolved? Am I going to be the 30% that's not going to respond? How do I know that? So we need more information, but I'm worried that politicians will jump the gun and say, look, we need this vaccine, let's just get it out. That is worrying.
Sam, we're also just getting a couple of news, of course, from, you know, the tiers in the UK. I don't know if many of our European counterparts have been spared. Frankly, it's confusing. And from December 2nd, so next week, we're no longer in the UK in a national lockdown. But of course, it'll be region by region. We understand, and the BBC is just confirming that, I think, that London is in a tier 2 after December 2nd. Sam, how much of you know, these lockdowns, partial lockdowns, tiers, whatever you want to call them, how much do they help scientists in understanding how the virus is actually spreading?
Yeah, so that's a really, really good question, Francine. We've got a situation, obviously, in France, where they were having very awful numbers of cases, and now it's come down quite significantly. But they left schools open, and they then changed the school pattern. So, and it's all done nationally. So this is not any regions. What the UK experiment, for want of a better phrase, is going to deliver is for people to be able to understand if there are differences in these tiers, are you getting differences in the speed with which cases are rising or falling? That's the sort of thing that I think they can do. And frankly, I think that local areas in France and in areas where they have the blanket approach would love to have that kind of tiered approach, because some areas just don't have the number of cases that other areas do. So why should they be under the same pressure? That's the kind of question that politicians, again, need to answer.
Sam, thank you so much. As always, Sam Fazeli there of Bloomberg Intelligence. Now, we're getting a couple of news from a couple of different sources. First of all, you're looking at a live picture of 10 Downing Street. So for those of you listening on radio, it's just a simple white door, and that usually happens when we're expecting the Prime Minister to come out and give some kind of announcement, what we know he will talk about when that door opens. And I don't know whether we'll see a glimpse of the Christmas tree yet, or whether it's even up, but we're expecting him to lay out exactly what happens post December 2nd, when we no longer have a national lockdown. And so the regions will basically be split in different tiers, confusing for some, but actually it keeps an eye on the coronavirus, on the pandemic, whilst letting other regions less affected to travel. The other piece of news we have is from Germany. Germany is planning to borrow about 180 billion euros next year. So we'll have plenty more, of course, on Germany. Remember, they have into their constitution and what they can and can't do for the deficit. They have to have a black deficit, so we'll come back to that. And of course, look at German bunds. I don't know if we have that. I think we may have it, but otherwise they're not moving by that much. But we'll see if they do in the coming minutes. Coming up, pressure on the retail industry to deliver Black Friday. So we'll talk a lot more about retail. And we have a full roundup of economics with Christian Schultz, City Economics Team Director. This is Bloomberg.
This is Bloomberg Surveillance. I'm Leanne Gerrans with this Bloomberg Business Flash. Now, the second largest mall in the US will get its first big test starting tomorrow on Black Friday. The $5 billion American Dream complex opened its retail stores last month. The timing is less than perfect, however. The coronavirus pandemic has driven more shopping online. Plus, the American Dream is built around experiences. Its indoor ski slopes and water park no longer hold the same appeal. And of course, it's not just about the American Dream Mall. All the big US retailers are struggling to adapt. They've tried to prepare for what will be a holiday shopping season like no other. Here's Bloomberg's Ritika Gupta.
Black Friday, the unofficial start of the holiday shopping season, is upon us. While retailers would normally showcase doorbuster deals, fully stocked shelves, and a frenzy of shoppers, COVID-19 has drastically changed the shopping landscape this season. Stores are rushing to adjust, offering seasonal deals earlier this year to avoid a holiday crunch. Stores are bulking up direct shipping and in-store and curbside pickup, with Adobe Analytics predicting a 40% rise in pickup shopping methods. Traditional brick-and-mortar businesses are also focusing on shifting to e-commerce. Online sales are expected to surge 33% to $189 billion, according to Adobe Analytics. That will not only pressure retailers to adapt, but will stretch fulfillment networks across the US. Getting that change is crucial for struggling stores to survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
And TikTok has bought some time with the Trump administration. Authorities have been given China's ByteDance another week to complete the sale of its popular video sharing app. TikTok has been downloaded more than 100 million times over in the US. The administration argues that private data gathered through the app could be funneled to the Chinese government. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. A lot to talk about today. Retail sales, we also have that headline out of Germany, which I'll get to in a second. But stocks are pretty much mixed. Here in Europe, they're down a little bit. Now, we did have some sobering economic data, and that's been deflating the spirited risk rally. Bitcoin tumbled as much as 13%. A reminder, of course, Treasury futures edging higher as the cash market is closed, with traders off for Thanksgiving holiday in the U.S. Our Tom Keene also off for Thanksgiving. Defensive tech shares gaining the most in Europe, and I'm also looking at cyclical companies, actually including banks and energy firms that have led the post-vaccine surge, retreating today. Germany, we talk about debt and the impact on Bunds. This is Bloomberg.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises it.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's talk about Germany, and let's talk, of course, about central banks as well. But Germany, a headline just crossing the Bloomberg terminal minutes ago, planning to borrow about 180 billion euros next year. Now, European bankers holding out for hope, or holding out hope for the freedom to pay dividends again. That, of course, is what the ECB is warning them of, the need for more bad loan provisions to soak up losses when government's pandemic support is ending. Joining us now is Christian Schultz. He's Citigroup Economics Team Director. Christian, great to have you on the program with us. When you look at, first of all, the borrowing that Germany will do we borrow now and worry about debt afterwards?
Indeed, we do. I mean, this specific number is, of course, due to the fact that we've got a second wave of the pandemic, another lockdown. The government is compensating businesses which had to close, which is a good thing, right? Because otherwise these businesses would be closing down. So it takes some of the losses of the private sector on the public balance sheet, which is exactly the right thing to do, and that drives up borrowing considerably. There's also a second driver, which is a bit less good, which is that the government actually hasn't borrowed that much this year. And so it's kind of postponing some of the borrowing into next year. So it's actually the borrowing this year is probably going to go down, and the one next year going up. But in general, yes, we borrow now, we worry about it later, and that is exactly the right strategy to avoid that balance sheet in the private sector get impaired, and we then have a long period of companies not investing, households saving too much, and governments having to do austerity.
Christian, what happens with austerity? Again, if we start thinking about austerity too quickly, is there a day, as soon as you start talking about it, and I've heard it from a couple of economists, does it mean game over for investors?
Well, somebody has to pay for this ultimately, right? The government debt is ballooning, and there's only three ways of paying for this. One is higher taxes, which for some economies in the world which have relatively low tax rates is probably a plausible path, but not necessarily for Europe, where taxes are already very high. The second is austerity. You cut spending, you cut welfare or whatever, or public investment, with all the consequences that brings. And the third is you make your creditors pay, whether that's by outright default, by inflation, or by just financial repression and keeping interest rates very low. And if you think about these three possibilities, again, higher taxes in Europe, probably not the ideal route. Welfare cuts, austerity, given the experience of 2011-12, the political repercussions that has, but also the sense after this crisis that the government needs to protect us more and therefore spend more, also not the most likely route. So I think the most likely route is actually that creditors pay for it, and that they pay for it via low interest rates.
But Christian, see, do you not actually, instead of austerity, can you not repay back through growth? And so if you look at what we've lived through, have we suspended the economy? So I know, the Italians are asking, or at least one advisor of the Prime Minister is asking for some kind of debt relief, which I'm not sure will fly with anyone. But if we're all in the same boat, should something not be done collectively?
Yes. Strengthening growth is one way to exactly grow out of debt. Two ways, I guess, are currently sort of in discussion. One is public investment, strengthening growth via public investment. That's been neglected in Europe over the last 10 years, whether that's infrastructure or green or whatever it is. And that is something that can, of course, in the long run deliver stronger growth. But the important point is in the long run, right? Public investment is very difficult to deliver, and it really sort of unfolds its positive effects over the very long run. And in the meantime, it creates even more debt, of course. The other is structural reforms, labor market reforms, things which are harsh in the short run, but in the long run benefit more growth. My feeling is that the structural reforms are currently completely out of the discussion, even though they're very necessary because the economies will have to probably adjust to at least some sort of long-term consequences and changes in behavior from the pandemic. That's unfortunately at the moment not so much in the discussion. Everything is focused on spending more, on investing more, but I think both avenues of strengthening growth should be pursued, but I don't think either of them is going to be effective enough to help us bring down the debt ratios of 150% or so in Italy, or even 70-80% in Germany, back towards the 60% Maastricht level over any meaningful kind of period.
Christian, what does it mean for bond yields? I mean, yesterday, on social media, we were looking at whether we'd see something below zero, or at least at zero, for Portuguese bond yields. I mean, what kind of precedent is this, and what does it mean for ECB policy?
Well, high public debt ratios are sustainable because of low borrowing costs, you could say. Or you could turn it the other way around. Because of these very high debt ratios that we're going to have to deal with for a very long period of time, and by the way, not just, of course, in the public sector, also in the private sector, require low yields. That's this financial repression argument that I already mentioned. It requires central banks to keep interest rates extremely low for a very long time. They would do that anyway because they really have no other choice in order to get inflation back to target. And we know that they are at their lower bound already, and that neutral rates are very low, and that the effectiveness of these low interest rates is going to be very, very small. Really, the only avenue via which central banks can really push the real economy forwards and ultimately close the output gap and hopefully deliver stronger inflation is via the effect on fiscal policy. And I think that is very crucial for the ECB. The ECB has to create fiscal space for all member states of the Eurozone, not just for Germany, but for all of them, which means it has to effectively control the yield curve, keep interest rates low across the curve, and the spreads as well for countries such as Italy. And so I think what we're going to see is the ECB deploying its pandemic emergency purchase program, the PEP, wherever necessary in order to keep yields low into any kind of upturn, and especially to keep spreads low, of course.
But Christian, when does the ECB start to normalize? And is there a danger that when they do that, actually yields go out of control?
Indeed, that is precisely the risk. If they normalize, then and if they step away from this yield and especially the spread control. So if the PEP program expires, the PEP program is particularly important because it has flexibility over what bonds they buy at what time. They can deviate from the capital key and from the issue and issuance limits. That's very important about this program. So if they were to phase that out, the credibility of that backstop to Italy and all countries would be severely diminished. However, I wouldn't be so worried about this because we know that there's other tools that the ECB can deploy, like the OMT, going back to 2011, 2012, the OMT with which it can control spreads as well. But that becomes politically a lot more problematic because that comes with conditions, with ESM programs and these sorts of things. So I don't think that the ECB can talk about normalization at all, and certainly not on the balance sheet. If anything, they can talk about getting out of negative interest rates at some point, because we know that those hurt banks and therefore perhaps the economy in the long run as well. So getting out of negative interest rates is one thing, and that's perhaps positive, but on the balance sheet, no.
Christian, thank you so much. Christian Schultz, our Citigroup Economics Team Director. Now, we're also just getting some breaking news on this has been confirmed. Lockdown for London. So we actually finished the national lockdown here in the UK on December 2nd. It is next week. And actually, the government is now updating everyone on the regions and the tiers for London. I know many of you, of course, are here in London, and London will then enter a tier 2. That's England's middle level. So you can still actually travel from one place to the other. But of course, many places will be in lockdown. Birmingham up north will be entering a tier 3 virus restriction after the lockdown. That's simply because cases in Birmingham are so much higher. Now, here with the Bloomberg First Word News is Leanne Gerrans. Hi, Leanne.
Hi, Francine. It looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of U.S. products slowed last month after hitting a high back in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. A divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against those limits. Chief Justice John Roberts joined the court's liberal wing in dissent. And here, Chancellor Rishi Sunak has opened a new rift within the UK's Conservative Party. Sunak has moved to cut the country's foreign aid budget. Some Conservatives say it's wrong to reduce spending on other countries, but the move lets Prime Minister Boris Johnson so his priorities are with the need at home rather than those overseas. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Happy Thanksgiving to all of our American friends. Now let's also talk about the future of European banking. In the last hour, we spoke exclusively with the BNP Paribas chairman, Jean Lemierre, and we started by asking him the big question for European banks. Of course, when can they start repaying dividends? This is what he said.
Of course, shareholders do wish to have a dividend. This is normal. They allocate capital to the bank. We use the capital they put in the bank, and they want to be rewarded if it is possible. I think the decision made, the recommendation given by the ECB has been broadly well understood at springtime. There was a high level of uncertainty. Nobody knew exactly what was going to happen. And even if it came as a big negative surprise, it was part of the negative news out of the COVID crisis. But to a large extent, investors, of course, are not positive, not happy, but I think most of them have understood. You see what I mean? The question is the decision which is going to be made by the ECB, the recommendation they will give in December. I think today we are still in difficulties. Let's be clear, there is a second wave of contagion everywhere in Europe and in the world. There are difficulties, lockdown is still there, and the reopening of the business is moving forward, but there are still many difficulties. So I think there's still a level of difficulties, but I think there's more certainty. I think we understand better what's going to happen. We understand better the risk ahead. We understand better the challenges we have, and in the dialogue with the supervisor is about these questions. So I hope that this understanding will help the decision-making by the ECB about the recommendation they will give in December.
Do markets have to be less exuberant, given we're not exactly sure when a good chunk of the population will be vaccinated?
Yes, once more on the vaccine, I think there is light at the end of the tunnel. I'm very confident scientists are developing vaccines and medicines which are going to help a lot people to go through this virus crisis. So there will be one. Now, we know there are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time, but at least there is a light, and that's what is very important. I think this is well understood by the market.
Is that Suffolk needs to be in tier.
Well, that was the BNP Paribas chairman, Jean Lemierre, speaking exclusively to me earlier on. Now, we're also getting an update from the UK Health Secretary, Matt Hancock, speaking in the House of Commons, outlaying the plans for post-lockdown for the UK. So currently we're in a national lockdown until December 2nd, and then he's basically laid out region by region and really metropolis by metropolis what will happen post-December 2nd. London will enter Tier 2, England's middle level, Manchester and Birmingham will enter Tier 3.
And Greater Manchester, and also for areas where cases have risen sharply recently, like Bristol, the West Midlands and Kent. The full allocations have been published this morning and laid as a written ministerial statement just before this statement began. I understand the impact that these measures will have, but they are necessary.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen.
And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's talk about Bitcoin and actually the roller coaster that we've seen over the last couple of days. Back in the headlines, cryptocurrency exchange traded products in Europe have now topped 1 billion euros in assets. Now, inflows have surged since October, but with the coin's price proving highly volatile yet again. Well, the flows have come despite regulators in the UK, the region's biggest ETP market, banning the sale of crypto-related derivatives to retail investors. So to talk a lot more about all of this is Danny Berger. Danny, what was the motivation behind the UK's move to crack down on cryptos?
Well, Francine, obviously cryptocurrencies have been extremely attractive to a lot of investors, a lot of retail investors as well. And I think the FCA looks at this and says, okay, there needs to be some more protection put in place for investors. So last month, the FCA decides to ban derivative crypto assets. So that's anything that doesn't directly invest in it, but rather tracks the price with things like swaps. This includes a lot of ETPs, exchange traded notes. That's a really easy way for retail traders to access this market. Now, the ban doesn't come into effect until January 2021, and we can see, given what cryptocurrencies have been performing like, it hasn't really stopped people. But look, there are a lot of people arguing that this isn't fair, that what it'll essentially do is push retail investors into unregulated markets versus perhaps a more regulated exchange-traded product.
Danny, thank you so much. Our Danny Berger there with the very latest on Bitcoins and these ETPs. Now, joining us to talk about the markets is Eddie van der Veld. He's our Markets Live editor. Eddie, first, I really enjoy our conversations also on social media. So one of the accounts that I enjoy the most is definitely Eddie on Twitter. When you look at markets and what the markets are looking at, what do you do with Bitcoin? I'm not exactly sure what the Bitcoin or Bitcoins are tracking.
First, Francine, thank you for boosting my follow account by about 1,000 just then with that declaration. But listen, Bitcoin is definitely the comeback kid of financial markets. People have been writing this asset off over and over again, and every time it just keeps bouncing back. Back in 2017, I was watching it very closely, and it came up to 20,000. It collapsed back down, and people were saying, look, it's all over, it's going to go to zero, and it eventually went back down to something like $4,000 a Bitcoin. And, here we sit a couple of years later, and we're back up at the all-time highs. Now, it's retreated somewhat overnight, but I think people are learning their lesson. I think people are learning that you cannot write off Bitcoin. This is not going to go away. I think it's now got a 12-year history, and it's starting to become a serious player in financial markets.
But Eddie, when you look at the forecasts, and this is kind of what surprises many who are not Bitcoin fans, I mean, these forecasts range from 35,000 to 250,000, if not more. Who's a reasoning voice in Bitcoin?
Oh, it is so hard. I mean, it's a very hard asset to call. It's just purely based on its volatility. This is an asset like nothing that anybody has ever seen before, and that makes it really hard to call. What we've seen in the past, though, and I think what's happening again this time, earlier in the year, back in May, we saw a tightening of supply. Every, I think, 210,000 Bitcoins that is, blocks that is created, there's a tightening of Bitcoin supply. And that's happened again back in May. And every time in the wake of that, we've seen significant rally. The supply tightening played a significant role. Of course, supply can only matter if you've also got the demand there. You know, just tightening supply alone won't matter if people don't want to buy this. But in the previous instances, we've seen Bitcoin rally by more than 1,000%. So I wouldn't say that there's anybody that can predict exactly how high it's going to go. It's still very much an unknown entity. But I think we've seen these previous squeezes higher, and they do go up significantly.
Eddie, so what do you do with gold in this kind of environment?
You know, yes, the crypto fans set this up as a battle between gold and Bitcoin for the role of ultimate safe haven and ultimate store of value. That's a hard one, though, because describing Bitcoin as a store of wealth when it is this volatile, you know, it seems to me a hard sell to make. And also, gold is a very different asset. But you know, there are some people that are getting out of gold and they are going into Bitcoin. So I think, you know, in the very long term, if Bitcoin starts to lose some of its volatility in the digital space, yes, it does become a challenger for gold.
Eddie, what else are you watching? I know you know we're interested in the correlation, which made me laugh, but actually was a very serious point in Tesla and Bitcoin. Is there anything else that we should be watching out for in you know the quirks of the markets in the next couple of days?
Yeah, look, markets have become very stretched. There's a lot of people that are talking about pullback across equity markets, perhaps as we go into New Year, because you know all of the good news from the vaccine and so on has been pumped into market. And then at the same time, we're seeing the jobs market in the US just seeming to cool down a little bit. So there's potential for just a reassessment as we go into the December period. But coming back to gold, I think gold is at risk of a real pullback. It had a mania earlier in the year. You know, it went through significant support levels or previous resistance levels, went up above 2,000, and I think it feels like the pullback is on the cards.
Eddie? The pullback on the cards by Eddie van der Velde. Thank you so much for joining us. We'll have plenty more, of course, on the markets. This is Bloomberg.
Können Sie einmal noch ganz kurz zu uns kommen? Ganz kurz.
It is 12 noon here in London, 7 a.m. in New York. US markets are closed, of course, today for the Thanksgiving holiday, but it is still a regular trading day here in Europe. So from London, I'm Anna Edwards. This is a special edition of Bloomberg Markets. Let's check those markets for you then now, and we'll go to the ones that are open, shall we? European equity markets move to the downside, down around 0.1%. Some of the sectors that are really being beaten up today, the banking sector and energy and autos and auto parts, but with banks and energy moving to the downside, it's difficult for London to make ground, difficult for the Spanish market to make ground, and so as a whole, European equity markets retreat, even if some of these indexes are actually fairly flat. The German DAX and the CAC 40 not moving all that much in this morning's session and into the afternoon here in Europe. So we are kind of directionless a little bit without the US trade, US futures, for what they're worth. No US equity trading today, but US futures are flat to positive. Positive if you're looking at the NASDAQ, flat elsewhere. In terms of FX markets, keeping an eye on that euro, it has been strong of late. A little bit of weakness today, 119.04, down 0.1%. And the pound, with all things Brexit in mind, as we're hearing the latest lines from UK politicians around easing of lockdown measures here in the UK and what kind of tiered arrangements we go to, the focus still for investors in part is on Brexit and those trade negotiations. 133.57, down 0.2% for the pound this morning. That's a quick look at the markets. Let's get back to the virus story, because AstraZeneca and Oxford University are facing mounting questions about their COVID-19 vaccine trial, the results of which, after they acknowledged a manufacturing error. Let's get the details now from Bloomberg Intelligence Director of Research, Sam Fazeli. Reading through this story, Sam, good to speak to you today. Reading through this story, it's quite interesting. It seems that an error resulted in only half doses being given to some participants, but they decided to persist with that, and it is now that so-called error that has resulted in some really divergent performance of the drug in trials. Give us a bit more detail on what we know about this error and what happened.
Yeah, good morning, Anna. So whether it's the error in that group that led to the difference, the apparent difference, I want to choose my words very carefully here, whether it's the error in that dosing group that led to the apparent difference in efficacy is unknown. They don't know why that would have been the case from a scientific perspective as regards to the dosing, etc., why the response would have been different. And we still don't know what the difference between the two groups was in terms of age, comorbidity, etc. And finally, whether it's actually real, whether if they added another 3,000 people with that dose, the effect would have turned up to be 100%, which of course is impossible because you already have X number of cases on vaccine, or less. So lots of questions left. I do not believe that number until I see the detail.
Okay, so we do need to see some detail. We've had some suggestions coming through from some. The head of the US vaccine program, Operation Warp Speed, suggesting that those who were given the lower dose were a different demographic, were younger, and we just don't know exactly all of those details, do we, Sam? But it had struck some as quite surprising that we're seeing such high efficacy rates in older people being reported by other vaccine programs, and indeed across the board for this one, because we know that vaccines in other situations, in flu, for example, simply don't work as well when you're talking about older age groups. So I suppose there's a lot we still don't know about the demographic profile of the people in the various groups here.
Not in this trial. We do know from Pfizer, however, Anna, that the efficacy in the folks over 65 years old was pretty much the same as that for the whole trial. So at least in that setting, there was no difference. If there is a difference here, then you do have a problem, because that's the group that needs the vaccine most in terms of the severity of disease. But again, until we see the details, all this has done is create confusion. And we were of the view all along that the best this trial can do, given the complexity of its design that Oxford University designed, not AstraZeneca, is quite clear. It will be at best hypothesis generating. Unfortunately, that's exactly what happened.
So if you're a country buying up supplies of vaccinations at this point, Sam, do we know enough to decide which vaccines you really want to go for? You might not have free choice in that. You might already have done deals with some and not other vaccine suppliers. How should governments be thinking about the relative merits of these different vaccines at this point?
Yeah, so that's a very difficult question to answer, Anna, and it's an excellent question. At the end of the day, I do wonder whether here that we have a vaccine that clearly does something, we just don't know how much or how well and in which groups and what dose, so there's a lot of things we don't know. Whether these governments who are reliant on the doses they've ordered for this, the only country that's got complete coverage for its population with the Moderna and Pfizer-BioNTech vaccines is the United States, from our maths. So UK, European Union, many other countries rely on the Astra vaccine as well in terms of inoculating their folks. So how much with politics, economics, Trump, science, and detail is something that we're going to find out quite soon, I'm sure.
Yeah, they're priced differently, and they also have different conditions attached in terms of transportation, don't they? Different requirements. Sam, thanks so much for joining us. Good to speak to you. Bloomberg Intelligence, Sam Fazeli. Lots of questions then still, in particular surrounding the AstraZeneca-Oxford vaccine. Joining us now with an investor perspective on how we navigate a path through the winter here, Bilal Hafiz, Macro Hive founder and CEO and editor. Bilal, very good to speak to you once again. So as we look at this sort of medium-term optimism, I suppose, around vaccines, notwithstanding questions around efficacy maybe around Astra and Oxford, there does seem to still be medium-term optimism, but short-term, a lot of pain, a lot of tragedy, actually, human tragedy, but also a lot of concern for how difficult the winter becomes. How do you go about thinking through the short-term difficulties and the medium-term optimism and balancing the two?
And that's a very good question. I mean, the first thing I would say is that, because we're in the second or third wave of the COVID virus, markets, it'll have less of a negative impact on markets in general, leaving aside the vaccine. It's always the first cut is always the deepest. So March, April was a period of maximum uncertainty. So we have less uncertainty around COVID. The lockdowns are a bit more smarter this time compared to the first one. So a general observation is that even without the vaccine, a second, third wave would have less of a negative impact on markets. The second point I would make is that the vaccine, I think, is very significant in the sense that one should, in general, weight much more towards the vaccine side of the story than the current COVID case side of the story. Because if you know that you have a vaccine that will be distributed at some point over the course of next year, that gives you a lot of certainty about how long these lockdowns will last. So my bias in general is generally to weight much more towards the vaccine than the current COVID cases. That said, we do know that the winter period will be quite difficult. So, geographically, one can then say that perhaps one should weight towards countries in the southern hemisphere who will be going through the summer. So whether that's South America, Australia, New Zealand, those sorts of countries. So there could be some sort of, some nuances there. And then the other point I would make is that there is, from a purely markets or economic perspective, what matters is not just the COVID cases and unfortunately the deaths, but also the lockdown measures. How much does the current COVID second or third waves have an impact on economic activity? And there are major differences around the world. So Europe is much more strict, the US less so, and so that will then be represented in the economic data.
Yeah, so you might want to think about the seasonality. That's a really interesting point, Bilal, which hemisphere you're operating in and investing in. And you also might want to think about the various geographies and the restrictive measures introduced. Even within Europe, Bilal, do you see big divergence, or would that be to overstate things? I mean, the most recent news points have suggested that the UK is loosening a little, that France is loosening a little, Germany is maintaining its stricter stance ahead of Christmas, ahead of the holidays. But maybe that's too simplistic. I mean, what do you expect to see as things develop through the winter in Europe?
No, that's a fair point. I do expect a loosening of some of the measures as we get closer to the Christmas period, and probably in most countries. You have to remember with Germany, the level of restrictions wasn't as aggressive as some of the other countries in the first place. But I do think, just like we've seen with the UK, there are some lifting of restrictions as we go into the Christmas period, because many of these countries recognize that, one, from a retail perspective, Christmas is an incredibly important, stage for businesses, but also from a cultural perspective, it's a time off for period for people. And what we have seen with the lockdowns, and if you look at the political responses to the current lockdown measures, there's less support for lockdowns this time around. And so the governments across Europe have to be very careful about keeping the public on side. So I do think there will be some sort of loosening as we go into the Christmas period.
And for those watching this in London, and there'll be a few, London is going to enter Tier 2. We found that out in the last hour or so. England's middle level after this lockdown Mark 2 is removed. As we look at all of these measures and what this does to our ability to get out and about, Bilal, as we enter into December, do we risk missing the bigger picture changes, the big structural shifts? And of course, we talk about those as well. But is that where your thought process goes? You know, how much of this work from home, which I'm enjoying so much this week, how much of that work from home will live on into the post-pandemic era, and what big changes that could make for investment strategies?
Yeah, absolutely. You know, my kind of sense, and this is something I'm telling all kind of investors and clients and so on, is that, you know, for me, the biggest story is not so much, you know, the current kind of lockdown measures or the vaccines even. It's more about what's going to be the enduring impacts of 2020 on our lives. And in some ways, if you kind of step back and think about this, what happened in 2020 was essentially the world went on pause. It was like a major reboot of the world where everything stopped. And everybody had to suddenly find a way of working when you weren't able to be mobile, which essentially meant a mass widespread adoption of existing technologies that weren't adopted before. And this is in some ways quite revolutionary. And what we're finding is, and this is all academic work has come out on this very recently, is that a lot more people have discovered that they can work remotely. And managers previously who were very skeptical of remote working have suddenly said, actually, it kind of works. And in fact, most have had a positive experience from it all. So I do think there will be this enduring impact on the labor force where we'll see much more remote working. And if we do see that, that has some significant implications. One, it has an impact on cities versus smaller cities and villages and so on, where people will now find it more comfortable to live outside of big cities. Also, people will have access to jobs that they didn't have access to before because they can now access it remotely. So that sort of opens up the opportunities that are available. So I think these will have some quite profound impacts on markets.
Yes, I'm sure it's a short-term phenomenon in my industry, but I'm sure for some industries it will have long-term impacts. And the distribution of wealth around various geographies could be really interesting to watch. Macro Hive's Bilal Hafeez, thank you very much. Stay with us. We'll have more with Bilal shortly. Let's get a First Word News update. For that, we stay here in London with Leanne Gerrans.
Hi, Anna. Here in the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city's been placed in Tier 2. That means pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be allowed to mix indoors. Now, it is the apparent close to a long and bitterly forced criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thank you very much, Leanne Gerrans, with your First Word News update. Coming up on the programme, investors with expectations for higher US inflation after the downturn may be in for disappointment. We'll take a closer look at the lasting impact of COVID-19 on the services sector and what does that mean for the inflation debate. That's with Bilal Hafeez next.
Sony's PlayStation 5 went on sale Thursday, and the company hopes it'll become a long-term cash cow. It's a key test for the Japanese company amid the pandemic's gaming boom, and it goes head-to-head with Microsoft's new Xbox. Both consoles have seen solid pre-order sales. The previous console sold 113 million units.
Okay, ladies and gentlemen, I am placing a stop for euro. I'm moving further, and I'm moving stop on profit to 119.12. Right here. Okay, stop on profit from 119.22 to 119.12.
Here in Europe for us today. Danny.
And it really does look like traders are happy to take a pause today after what we've seen as being an impressive rally so far in November. Stock 600 down 0.1%. But also what we're seeing is a reversal of some of the euphoria that's been in the markets the past couple of days. Those higher beta cyclical sectors are really what's leading the market lower. In the stock 600, UK stocks certainly having a big drag today as those London tiers get announced. And looking at S&P 500 futures, they are flat. But again, this goes back to that reversion to a safety trade, though cash markets are closed. Futures in the NASDAQ are getting a bid of 0.3%. Again, it's that safer sort of tech trade we're seeing. Now let's look at some of the currencies and switch up the board. Dollar spot, it is gaining, according to Stephen Innes of SPI Asset Management. There's been a huge corporate bid for the dollar ahead of the Thanksgiving holiday. So just really holding on to that bid during a day with lower volume. Bitcoin, we've been talking about this a lot, a nearly 8.5% decline. But look, Bitcoin's so volatile that sometimes perhaps an 8% decline isn't that huge. Coinbase CEO also talking of perhaps some more regulation across the digital currency space. So that is certainly pulling back from some of that record rally we've seen in the digital currency. Pound also moving lower, trading at the lows of the day, down 0.25%. Again, some of that news over the tier system, dragging the pound down perhaps in Brexit talks as well. But look, I want to get into the charts because the trend of the pound over the past few days has been higher. Yes, it's lower today, but in the blue, if we look at what the pound has been doing, trading near a 3-month high. But underneath the market, that optimism is not there. In fact, it's more bearish. The risk reversal is now trading near their lowest in September. Sebastian Galen of Nordea says that not enough risk for no deal is currently priced into the market. So perhaps we're seeing that in options, Anna.
Yeah, really interesting. Danny, thank you very much. Danny Berger on the markets, and she was talking there about UK assets. Worth mentioning, the UK's Matt Hancock, the Health Secretary, says that the virus cases are rising in parts of London. A lot of work still to do to keep London in Tier 2. So let's remember that as we head into December, if you are, like me, in the UK capital. Now, still with us, Bilal Hafiz, Macro Hive founder, CEO and editor. Bilal, we talked a bit about the virus and how it's managed and how that impacts on investment strategy. What about the impact that it's having on inflation? I know that you've been giving some thought to the way that the service sector has been hit through the pandemic and what impact that should have on our inflation expectations. Can you link up some of those thoughts for us?
Yes, absolutely. Of course, one of the biggest debates at the moment is, will inflation go up or will it fall in the period going forward? The people who are very bullish on inflation or expected to go up are focusing a lot on the build-up in debt, the amount of printing by central banks. But for me, the most important thing is much more to do with the supply side aspects of the virus and which part of the economy is affected the most. And unlike any other recession, it's a service sector that has been completely negatively impacted during the COVID period. So that's the part of the economy that has really dropped significantly, whereas manufacturing held up. And if you look at inflation in advanced economies, in rich countries, most of inflation is service sector inflation. And so it's really, and if you go back over the last 10, 20 years, the only area of inflation we have seen in rich countries has been service sector inflation, whereas goods inflation, the cost of TVs and such things, have been close to zero. So my sense, first of all, is if it's a service sector negative shock, therefore, you should naturally see a downward pull on inflation. And then longer term, my point there is that within the service sector, the technological adoption that you've seen over the COVID period should structurally lead to lower service sector pricing pressures going forward.
Yeah. It's really interesting, isn't it? Because we were dealing with low inflation and lots of questions as to why that was, even before the pandemic, weren't we, Bilal? And now we've got added dynamics to consider. And I wonder if one of those is the news about the vaccine and what that does to people's propensity to consume, to consumers and also to investors' propensity to invest, businesses' propensity to invest, rather. If you know that the vaccine is coming, does that change things? Does that add a little bit more pricing power? How do we deal with that vaccine news flow when it comes to inflation expectations?
Yeah, no, that's very true. I do think that this will lead to a build-up in demand and greater optimism and greater investment and so on, which could, in the short term, have somewhat of a positive impact on inflation. So there could be a bit of a pull up in inflation, and there's certain base effects that will see inflation pick up. But already, a lot of that is likely to be seen through commodity inflation. So oil prices have been picking up, food prices have been picking up. So the food and energy component of inflation, is probably the area where you'll see most of that occur. Outside of that, I think it's less clear, because if you think about the main areas of service sector inflation, one is medical costs. There's been a big spike in medical costs this year because of COVID. That's probably going to start to head down. The other is education. So, are educational establishments, are they going to increase their prices in the years to come? I doubt it, especially with remote education and so on. Then there's a big one, housing. Are rents going to pick up significantly going forward, or instead are we going to see a move out of high rent locations like cities towards lower rent places, which will then have this inflationary impact?
And we've seen, Bilal, Philip Lane, chief economist at the ECB, just speaking in the last minutes, saying that it is essential not to let the yield curve steepen prematurely. And I guess this feeds into the inflation conversation, doesn't it? The extent to which central banks are going to be desperately trying to keep yields low to enable all indebted parties to pay back those debts.
Yes, absolutely. And Europe has a chronic, low inflation problem. I mean, core inflation is around 0.2, 0.3%. I mean, it's anemic, the inflation there. So Europe really does need to do whatever it can to sort of boost inflation. And the importance of the yield curve is that, if you have inflation so low, if the yield curve steepens a bit, you end up with positive real rates in an environment where you really want to boost your economy. So this is the message from the ECB that they really want to keep policy very loose, keep the yield curve low to really, allow consumers and businesses to have the best interest rate environment possible.
Bilal, thanks very much. Thanks for joining us. Macro Hives. Bilal Hafiz, thank you very much for spending this period of Thanksgiving with us. Coming up on the programme, George Buckley, Nomura Chief UK Economist and Co-Head of European Economics, will join us. Lots to talk about with George. We'll certainly talk about the ECB latest news flow, because there's an advisor to the Italian Prime Minister who's been calling for the ECB to forgive some of the pandemic debt. We'll get into that conversation. Are we talking about debt forgiveness? Are we talking about just increasing the maturity of debt? What, if any, of that is going to be possible in the eyes of the ECB? Excuse me. So we'll talk about all of that coming up. European equity markets then are open, even if markets stateside are closed, of course, for Thanksgiving. European equity markets are open, moving to the downside, down by around 0.1%. Banks, autos, auto parts, energy stocks under pressure. An interesting mix of things to the upside. We have healthcare and travel and leisure stocks going higher, providing just a little bit of upside where we find it. European equity markets then on the back foot, looking for a bit more guidance perhaps tomorrow on Black Friday from the United States. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Markets. I'm Anna Edwards, live from London. Happy Thanksgiving if you are celebrating. If you're here in Europe, then European equity markets, of course, are open. European equity markets looking a little bit directionless this hour, down around 1/8% as a whole. The FTSE 100 down 0.6%. The CAC and the DAX do a little better. The IBEX over in Spain also retreats down around 0.75%. Interesting to watch the euro right now, down 0.2% at 118.89. And we've had some interesting comments from the chief economist at the ECB. ECB's Philip Lane says he sees the first signs of worrying financing conditions. What implications does that have for the banking sector and indeed for European corporates and the broader European economy? We'll think about that as we go through the next couple of hours or so. Let's get a first word news update. For that, we go to Leanne Gerrans. Leanne.
Hi, Anna. The Trump administration plans to keep up the pressure on Iran during its final days in power. The U.S. sanctioned 5 companies in China and Russia for their alleged dealings with Iran's missile program. More sanctions on Iran are expected in the coming weeks, related to weapons of mass destruction and human rights. It looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of U.S. products slowed last month after hitting a high back in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. A divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against those limits. Chief Justice John Roberts joined the court's liberal wing in dissent. And shipping industry associations are calling on the world's richest person to bail them out. The problem, some 400,000 sailors are stuck on merchant vessels because of restrictions to stop the spread of the coronavirus. Shippers wrote an open letter to the Amazon founder Jeff Bezos to pressure global leaders to recognize seafarers as key workers. They say Amazon's success relies on shippers. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thank you very much. Now, Germany has registered a record increase in new coronavirus cases, bringing the total to just under 1 million and prompting an extension to the country's partial lockdown.
The measures that were put in place on October 28th will be continued, firstly until December 20th, and we're expecting, and this is something that the states and federal government are in agreement on, that because of the very high infection numbers, the restrictions will have to be in place until the start of January.
Here in the UK, Chancellor Rishi Sunak has set out spending plans as the country faces the worst slump in the economy in 300 years. And in Italy, Prime Minister Giuseppe Conte's closest advisor is calling on the ECB to consider wiping out government debt bought during the crisis. Let's get the latest on some of these developments. Bloomberg's Maria Tadeo joins us now from Brussels. Maria, let's start then on the German situation. As we were hearing from Bilal Hafiz, it's difficult to compare one part of Europe with another. You know, the lockdown Mark II that we saw in Germany was not as tough as it was in other parts of Europe, and maybe that's why it needs to be extended for a little bit further. Different parts of Europe taking slightly different strategies from here.
Right, Anna, and that's why this is becoming difficult to implement on a policy aspect. The numbers are different in every country. If you look at the situation in Germany, Angela Merkel was very clear that she doesn't like the numbers that she's seeing at this point, and that Christmas doesn't mean that restrictions have got to be lifted or can be lifted. And in fact, they're now being extended until December 20th. When you look at the situation in France, it's different. Emmanuel Macron is really gearing up the country to reopen by December 15th. But you could argue that at this point, the French were immersed in a second wave, and they're more in a stop-and-go strategy. When you look at other countries like Spain, Italy, they haven't gone for a national lockdown. So it's the fact that you do get different situations in different countries and still policy whiplash between member states that is making this difficult. And I would say on that note, there is somewhat of a diplomatic spat that is being, or perhaps could brew over the next few days, which has to do with the skiing resorts, what to do with them as we enter into the Christmas period. This is a crucial time for skiing resorts. This is a big industry for Europe. As you know, Italy, France, Germany, and Austria all share skiing areas. Some countries like Austria do want to go ahead and open. The Germans are saying they don't want this to happen. The big implication here is that, of course, in Europe, we operate under Schengen. There should be freedom of movement, and that may complicate things better. So again, that feeds into what you were saying. It's the different measures that are making this a one approach coronavirus response difficult in the EU 27.
Yeah, meanwhile, we saw the role that skiing played, or skiing destinations played, in the spread of coronavirus in the first part of this pandemic, Maria, didn't we? On another matter, we're watching these lines coming through from the ECB accounts, and we'll get some analysis of that shortly with our next guest. But on the subject of the ECB, one of the other stories that's really interesting this morning here in Europe has been this Italian call, and a key advisor to the Prime Minister in Italy asking for or suggesting that the ECB should go about some debt forgiveness when it comes to all of the debt that is bought up from European governments. What's the latest on that, Maria?
Yes, Anna, and this is an interview by Bloomberg that's generated a lot of reaction today, and we're talking with one of the key aides of Giuseppe Conte, I would say the Italian Prime Minister, who's clearly putting out three ideas. The European Central Bank could cancel some of the debt that is taken on during the pandemic. They could also exclude from the deficit calculation the money that you put forward for green policies, and they're also perhaps putting forward another idea that suggests that some of the maturities of the debt could be extended for so long, almost ad infinitum, that in a practical way you end up not repaying it. But I would say this is a debate that is not new. All of these ideas have been floated. What is interesting here is that this is coming from a member of the Italian government, from someone that is close to Giuseppe Conte, the Italian premier. This is not just some professor in a university considering or floating ideas. I would say, however, when you look at the reaction we have heard already from the French, Bruno Le Maire, the finance minister, almost pushing back against the idea, saying that debts you have to repay. When you take on a debt, you assume that you will have to repay it. And of course, you run into a much bigger issue here, which is the opposition that you could get, and probably Italy will get, from Brussels and Berlin. They've always said canceling debt is something that the European treaties do not allow for, but also repeated many times the idea that the best thing you could do when it comes to debt sustainability is be fiscally responsive. So a number of hurdles here for that idea that the Italians are floating.
Maria, thank you very much. Maria Tadeo in Brussels. We'll pick up on that story shortly. I want to get next, though, to George Buckley, Nomura chief UK economist and co-head of European economics. And I want to, good afternoon to you, George. I want to come to you on the latest lines coming through from the ECB and its accounts, talking about how the euro area recovery was losing momentum. The risks are clearly tilted to the downside, according to the ECB accounts. Also making an interesting point, and this ties into what the ECB does from here. The ECB accounts saying that more bond buying might not have the same impact now. Do we see a sort of diminishing returns when it comes to the PEP program and other quantitative easing bond buying programs that central banks have put in place? What's your response to that line of thinking?
Well, certainly the ECB is coming out and saying now that it can't exclude, for example, a double dip recession. And to be honest, I think it'd be surprising if we didn't get a double dip now. So they do need to do more. They are going to do more come the December 10th meeting. Now, of course, when you start to increase the amount of quantitative easing to the scale that they have done, it is questionable whether it's doing the same amount of good. And one of the reasons is you have to question why is it helpful? And one of the reasons it's helpful is it's helpful in pushing yields down, but yields are already exceptionally low. So it's questionable just how much more they can do. Of course, by taking government bonds out of the mix, investors have to buy something else, and that could be very positive for financial markets. But it may have been the case that by preventing Italian yields from rising even more than they did back in the early part of this year, that had a much bigger effect than it would do now when we don't have that problem.
What can the ECB do, George, that is within the rules that they are allowed to do that means that governments can increase borrowing substantially? Many of them are going to be doing that to help their economies through this pandemic. Is the ECB doing exactly what it can do? It's the buying of government debt, and that's what we've seen already. Or is there anything in this Italian call for some kind of debt forgiveness, or even if we don't go that far, some sort of extension of the maturities on some of the European government debt?
Well, as Philip Lane was talking about earlier today, it's all about keeping financing conditions as favourable as you possibly can, whether that means keeping a lid on long-term interest rates. So, for example, government bonds via the PEP program and the asset purchase program, or whether it be via short-term yields, and whether that be potentially cutting interest rates again, or more likely the making the teltros more generous, the lending to banks much more generous, and encouraging banks to on-lend that cash to the real economy at lower interest rates. So I think it's all really related to keeping interest rates low and encouraging firms and households to borrow.
Right, and so is that going to be the focus of things then from the ECB? Is it going to be about more cheap loans to banks, more teltros, rather than the PEP QE program, George? Just looking at the lines from Philip Lane earlier on today, he said there are some worrying signals in recent survey data, and this is about financial conditions or financing conditions. He says we will recalibrate our instruments as appropriate to respond to the unfolding situation and to ensure that financing conditions remain favourable. Is there a worry then that banks might not be able to do as much as governments want them to do, or central banks want them to do, to support businesses at this time?
I think there is a worry, but I don't think we should rule out quantitative easing as being very important. I suspect that if the European Central Bank did absolutely nothing to expand or extend its PEP program, the markets would be exceptionally disappointed. So I think it would be better for the ECB to do more. It's always better when you add all of these policies together and try and loosen in various ways, a package of measures, if you will, throwing the kitchen sink at the whole problem. Because the two problems that we've got right now is, in the very near term, we have GDP, which is likely to fall again over the winter months. But the second problem is that inflation, even before the pandemic, was being revised lower, expectations of inflation. And it's still the case that we're not expecting inflation to be much above 1% in 3 years' time. The European Central Bank thinks it won't be that far ahead of our forecast, probably 1.3, 1.4. But that is materially below what the ECB would like it to be, which is close to but below 2%. So I think that they need to do a lot in order to try as best they can to throw everything at this problem, to help GDP through and the economies through the crisis, but also to try and encourage inflation expectations higher.
Yes, and in terms of thinking about those inflation expectations, we heard from De Guindos of the ECB over the last 24 hours. He was saying that the vaccine has bolstered sentiments. I wonder if you see that in any of the data that you look at, George, any of the high-frequency data that we're now so used to sort of poring over. Does any of that suggest that as we've got more concrete proof that vaccines can work, that consumers have been prepared to spend more, that businesses have been prepared to invest more? Has any of that come to pass?
I think it's probably a bit quick to see that in the data as yet, but certainly we have seen the equity markets respond very positively to the vaccine news, and also that will have an effect on some of these surveys which measure things like expectations and analyst expectations of where things are going in the future. So to the extent that the markets are responding positively, that might also be encouraging for household and firms' expectations.
Okay, George, thanks so much for your time. Really good to speak to you today. George Buckley of Nomura, thanks very much for joining us. Coming up on the programme, it is the biggest shopping day of the year, tomorrow that is, how retailers are transforming to a more COVID-friendly solution for the holiday season. We'll talk about Black Friday, that conversation coming up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I'm Anna Edwards, live in London for you. European equity markets moving to the downside then, down by around 0.1% this afternoon. Of course, European equity markets are open. US equity markets not open, not giving us that usual direction. For what it's worth, US futures look fairly flat. NASDAQ futures, though, point to the upside. In terms of FX markets, we see a little bit of weakness in the euro. Interesting comments from Philip Lane around financing conditions in Europe. And, of course, we have those ECB accounts not ruling out a double-dip recession for the Eurozone. Let's talk about shopping, shall we? Black Friday marks the unofficial start of the holiday shopping season. But as with everything in 2020, it's going to be different this year. COVID-19 has changed the shopping experience, and America's biggest retailers and department stores are rushing to adapt. Bloomberg's Ritika Gupta reports.
Black Friday, the unofficial start of the holiday shopping season, is upon us. While retailers would normally showcase doorbuster deals, fully stocked shelves, and a frenzy of shoppers, COVID-19 has drastically changed the shopping landscape this season. Stores are rushing to adjust, offering seasonal deals earlier this year to avoid a holiday crunch. Stores are bulking up direct shipping and in-store and curbside pickup, with Adobe Analytics predicting a 40% rise in pickup shopping methods. Traditional brick-and-mortar businesses are also focusing on shifting to e-commerce. Online sales are expected to surge 33% to $189 billion, according to Adobe Analytics. That will not only pressure retailers to adapt, but will stretch fulfillment networks across the US. Getting that change is crucial for struggling stores to survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
That was Bloomberg's Ritika Gupta with a look at holiday shopping stateside. Charles Allen, senior retail analyst for Bloomberg Intelligence, joins us now. And Charles, I know your focus is more on Europe, and we'll get to that in a moment. But just reflect on what we were hearing there from Ritika on just how different this holiday shopping season is going to be compared to other years. Today looks different for a start in terms of the US retail space, doesn't it?
Yeah, it's that almost all the big US retailers that had gradually sort of had a few hours opening on Thanksgiving, usually in the afternoon, have decided to close. So Walmart, Target, Best Buy, etc., will not be opening today. I mean, you can shop online if you want, but it's sort of making sure that all the employees have a holiday as well.
And in terms of the European experience, I mean, clearly Black Friday has become an increasing presence, I suppose, in the UK, either on the high street or in terms of online shopping. Is that going to change this year? There's certainly been some pushback. The UK is a bit different, isn't it, to other parts of Europe? There's certainly been some pushback against the sort of Black Friday, Amazon in particular, phenomenon in some parts of continental Europe recently.
Yeah, I mean, there's sort of all sorts of different things going on. I mean, in France, they've postponed it for a week, including Amazon, so that all the small retailers can participate once the lockdown finishes tomorrow in France. I mean, in the UK, it's a mixed picture. Obviously, non-essential retailers are closed tomorrow, so you can't go to some shops. I think, the other thing about this year is that, one typically associates Black Friday with, things like electronics and computers and things like that as sort of big bargains for that. I'm sure there will be some of those offerings around because people will have bought for it. But you also have to remember that these have been really strong categories through the whole lockdown. So an awful lot of people have bought themselves a new computer or a new TV this year. So it's not the things that normally people would buy are not necessarily going to be in as much demand as they may have been last year.
And in terms of the UK shopping experience, Charles, clearly Black Friday has become increasingly important, but there's also a big sales phenomenon that happens on what we call Boxing Day on December 26th, just after Christmas Day. I see a headline just crossing, very timely for our conversation with you, Charles, a headline just crossing from Marks & Spencer's, a UK retailer, says M&S reverses its decision to open on Boxing Day so that colleagues can spend time or more time with loved ones. That's another part of the balancing act that these retailers are going to have to throw into the mix. It's of course about making the most of the time they are able to be open, but also mindful of the tough year that 2020 has been for many of their staff.
Yeah, and actually, given that Boxing Day falls on a Saturday this year, it's really quite a big decision to say that you're going to be shut on that Saturday. But yes, it sort of mirrors what the people in the US have done and what was traditionally a holiday for shop workers as well, but then became more and more of a working day. So decision to just make it, an online only promotional day probably makes sense for a lot of people.
Now, whether it's Black Friday in the US or Boxing Day in the UK, we always look to illustrate, in TV land, Charles, we look to illustrate these stories with images, pictures of people cramming in through doorways, trying to get to the latest bargains. That just simply is not going to happen. Are some stores on both of these occasions going to be taking some quite drastically different approaches to actually limit the number of people who can get into their shops?
Yeah, well, I'm sure that they will be, and I'm sure that they'll have to. There has to be concern for the safety of their employees as well. So you don't want, 10 people crowded around every employee, even if everyone's wearing a mask. So I think, the companies like Primark, have got one-way systems to go through stores. You've got, make sure there's more distancing. There's obviously more protection around all the till points. Things like changing rooms are either closed or, under a different regime. So yes, it is. And I think this is probably even more true in some countries in Europe where the social distancing will be even more enforced than it is here.
And when we normally talk about Black Friday, Charles, we talk about the danger that can be posed to margins. Just briefly, is it going to be that same conversation again, or is just 2020 is just so different?
Well, I think that the retailers have moved on from just discounting their regular stock for Black Friday. Once it became apparent that it was a major promotional event, they bought merchandise especially for it, just as they had done for Boxing Day sales and things like that. So, the TV that you see at a really attractive price on either today or on Boxing Day has probably been bought especially for the occasion, and the retailers will make a good margin on it. But so,
Charles,
I don't
thank you very
so,
much.
anyway.
Thanks for bringing us the analysis. Yeah, we'll keep Okay, we'll keep an eye on that margin story. Charles Allen of Bloomberg Intelligence, thank you. Coming up in the next part of the program, our next conversation, we are going to be talking with Alberto Gallo, Algebris Investments Portfolio Manager. We'll talk about what he's been learning through the pandemic, what 2020 has taught him as we get closer and closer to the end of this year. This is Bloomberg.
In our interconnected world, if people in low and middle income countries miss out on vaccines, the virus will continue to spread and the economic recovery globally will be delayed. Equitable access is in the national interest of each and every country.
But this also means if we have a vaccine, we should have a common approach to give a fair share to everyone so that the most vulnerable groups, the frontline workers and the healthcare workers, for example, are the ones who get the vaccine first.
We're donating another $70 million to fight COVID-19. $50 million of that will be for buying vaccine doses for low-income countries, and another $20 million will be for researching even further in new vaccines altogether.
Il nous faut nous assurer que les conditions réglementaires et politiques sont toutes réunies pour un accès le plus large et rapide possible à ces produits, tout en respectant les standards internationaux de qualité. C'est pourquoi la France propose que puisse être rapidement adoptée une charte d'ACTA qui réaffirme ces grands principes: partager la connaissance, soutenir les systèmes de santé, avoir des produits rapidement accessibles et abordables.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It It is 1 p.m. in London, 8 a.m. in New York. From London, I'm Anna Edwards. US markets are closed for the Thanksgiving holiday, but it's still regular trading here in Europe. Welcome to Bloomberg Markets. Let's have a look at those markets. We've got European equities down by 0.1% right now. The stock 600 down by 0.1%, as I mentioned. Difficult for the London market and the Spanish market actually to make ground as we see selling in energy stocks and banks. Interesting moves in the pound. We heard from Philip Lane over at the ECB talking about concerns around financing conditions for small, medium-sized businesses, perhaps. And so that was an interesting story to watch last hour. 118 is where we trade. So we've dropped down from that 119 handle on euro-dollar. It is Thanksgiving. Let's kick off this hour with some US politics. In the US, two very different messages from the incoming and outgoing presidents this Thanksgiving.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts he has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
Contrasting visions then, contrasting assessments and priorities, I suppose, from the US president and US President-elect. Let's talk to Kathleen Hunter, who covers US politics at Bloomberg and joins us now. I suppose we shouldn't be surprised that the messages are so different, Kathleen, given the very different focuses we saw in two presidential campaigns running through much of this year.
Absolutely, and I think those different types of messages we saw reflected in the Thanksgiving speeches that we heard, or the Thanksgiving addresses that we heard from Trump and Biden, just now. I think that also, though, it's important to remember that, Trump is the incumbent at this stage, and so, he obviously is going to paint a rosier picture of how things stand in the U.S. than one that Biden might paint. Then Biden, of course, is going to talk about, the need to change things and, make them better in the new year. And so I think in that sense, it's kind of traditional what we would see from an incoming and outgoing president. But of course, because this is Trump and Biden, everything's just a little bit more of a stark contrast.
Yeah, not necessarily so typical in that sense. Kathleen, we are coming to the end, really, of the Trump presidency, aren't we? But he is, of course, still president, and he's still making decisions, and he's still taking actions, as you would expect. To what extent is there nervousness in the Democratic camp as to what President Trump might do through December, whether that's on Iran or on China or in other policy areas?
Well, of course, I think there is nervousness out there. We've seen that reflected in, the news stories that have come up. And, I think it's a result of the actions that Trump has taken. There have obviously been reports that he, has considered in recent days some kind of a military strike on Iran. Obviously, that has not happened. There's no indication that would in fact happen. But, I think that's a question that's on people's minds. He's taken actions already toward China. And this is all against the backdrop of having, major shakeups at the Pentagon and the Department of Homeland Security. And, that right after the election, for instance, he fired the defense chief. And so I think that is making people nervous. There's still about a month and a half that Trump's going to be president, and he is going to be the one setting the policy for the U.S. Through that time.
Kathleen, thank you very much. Bloomberg's Kathleen Hunter with an assessment of the US political backdrop this Thanksgiving. Let's get to how markets are reacting to news from around the world today with Alberto Gallo, portfolio manager from Algebris Investments, who joins us now. Alberto, good to speak to you. So we're having a conversation with Kathleen about the contrasting assessments of where the US is at the moment. When you try to look at the latest data we've got from the US, some of it has looked quite mixed, hasn't it? When you look at jobless claims maybe and retail stories not looking quite, the consumer story not looking quite so rosy, but other parts maybe asset investment by businesses maybe more positive. How do you assess the tough winter ahead in the US, Alberto?
There is a lot of good news in the market. The first most important news is we have a vaccine that is going to be distributed before the end of the year. So we're going to get the first doses out, both in the US and Europe, before the end of the year. At the same time, the economy has rebounded. Mobility data shows us that people are out, even though there are some lockdown measures. So, if you take a look from 30,000 feet, it looks very much like a V-shaped recovery. But if you look under the hood and you look closer, it is a K-shaped recovery, and there is still a lot of sectors and businesses that are behind, and also states and parts of the country that are behind. So markets are very euphoric. We went from euphoria in Q1 2020 to panic, and now we're back towards euphoria. The fear and greed index is at 88%, where 100% is maximum greed. So we are definitely happy because there are some positive developments, but our investment stance is a lot more cautious compared to March, April, or May, where we were deploying capital and buying a lot of risk assets at fire sale prices. We're a lot more selective now.
Okay. Right. I wanted to ask you about what you're doing with your portfolio, Alberto. You mentioned the fear and greed index. How greedy are you for some of the more cyclical plays then at this time? How tempted are you to reposition the portfolio around some of those reopening trades, the cyclical stories, the value stories, given what we know now about the vaccines?
So we want to position for a reopening of the economy. We have been lending money to firms in sectors that are linked to face-to-face activity, for example, hotels or cruises or airlines. We want to be in the right part of the capital structure, so have a senior or a secured claims on assets. And investors have been paid very well for lending to these sectors. In a world where interest rates are very low, at zero or negative, and they're likely to remain low for the next few months and possibly years. So we like those sectors. We also like the cyclicals, traditional cyclicals like industrials and banks. And generally, I would say that across asset classes, we see still some value in equities in non-US markets, so Europe and emerging markets, and in credit, but only in those sectors. So the indices, the benchmarks have gone a long way. They're back to pre-COVID levels. So we want to be a lot more selective. Now, the real question is, who's going to pay the bill? Because there's been, as you know, a lot of investment from governments, a lot of borrowing to bail out the private sector, and interest rates are capped at very low levels. But eventually, high government debt will call for some measures, and we know what they are. It can either be forcing investors to receive low interest rates, negative against inflation, or higher taxes. So we see very little value in government debt at these yield levels.
Okay, and so if somebody has to pay, when does that paying back start, Alberto? When would it be sensible to start those conversations? Because the IMF and others have been urging governments to keep those fiscal taps open for the moment.
Essentially, if you're a bondholder in government debt, you can either lose money slowly or you can lose money quickly. You lose money slowly if central banks keep interest rates low and fiscal stimulus drives inflation a little bit higher, not to very high levels, but we're talking about a range of 1 to 2.5%, which is already much higher than what you get paid on government debt. You lose money quickly if bond vigilantes wake up and start unwinding holdings of government debt and move into other assets. But so far, central banks have leaned against this. So something in the end has to give. And generally, I would say we're in the first scenario where bondholders are going to see yields rise, price drops, but very, very slowly. Central banks will maintain a dovish stance, as we've seen from Philip Lane earlier today, but governments will try to essentially borrow more at very low levels and inflate out the debt. There are also some governments that are more aggressive. We saw in the UK the reform about retail price inflation, so bonds that refer to RPI, which was a complex indicator with a lot of flaws, will now refer to CPI starting from 2030, and CPI usually pays a lot less, and bondholders are not getting compensated for that change. So essentially, some countries may just change your inflation indicator and pay you less on your inflation-linked debt. And on nominal debt, they're paying you already very little.
Okay, so those are some of the risks for bond investors. Where are the bond vigilantes, Alberto? Do you think, given what your reference to them there, do you think they'll come back?
I think they are asleep at the moment. I don't think they are completely dead. We need to understand how much fiscal stimulus the Biden administration will be able to create next year. And we still have the elections in Georgia with 2 Senate seats that may be won by the Democrats. And in that case, with a potentially blue Senate, the door to more fiscal stimulus is open. I would say that there is a lot of optimism in markets today with the vaccine, and it's a good thing, but a lot of this optimism is underpinned by a very dovish stance from monetary policy. And I think that will continue for next year. But the easy gains have been made, and we were bullish, in the period just following the virus. Now we've got to be a lot more selective, and if there is a trap in the market, is to be invested in sovereign debt. We definitely don't want to have that overall in our asset allocation. Or if you are, you want to be a lot more selective, only in a few countries. It's a lot tougher now than it was 6 months ago.
Thank you. I think we've got a different view coming up later on in the program in terms of sovereign debt, so really interesting to get your perspective. Alberto Gallo from Algebris Investments, thank you very much for your time this afternoon here in London. Let's get to the first word news now, some of the big stories we're covering here at Bloomberg, and for that we go to Leanne Gerrans. Leanne.
Hi, Anna. Here in the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed into Tier 2. That means pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be allowed to mix indoors. Now, it is the apparent close to a long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. A cryptocurrency boom has just turned into a mini bust. Bitcoin and other digital currencies have plunged by double-digit percentages. That is likely to stoke speculation about the durability of the rally. Even with the retreat, Bitcoin has more than doubled this year. And Disney has announced 4,000 more job cuts after virus lockdowns forced the closure of its theme parks. That takes the number of layoffs set for the next 6 months of the year to 32,000, more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses like studios, parks, and cruises. And the Trump administration is considering a move that could boost travel. Several agencies are urging the White House to lift an entry ban on non-US citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the transatlantic market. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thanks very much for that, Leanne. Coming up on the program, managing differences. China's president congratulates Joe Biden on his election win. We'll look at the relationship between the two countries under a new US administration next. That conversation coming up here on Bloomberg Markets this Thanksgiving. This is Bloomberg.
it is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back this Thanksgiving to this special edition of Bloomberg Markets. Let's check out the market action. There are some markets trading. Danny Berger has been looking at the movers. Danny.
Anna, there are markets trading, but it's important we keep in mind that those that are trading, volumes are still severely depressed, rather. In Europe, volumes are off as much as 30% in some of these markets. So keep that in mind as we look at a market that's really struggling for direction. The Stock 600 has pared some of its losses down around 0.1%, but it really is value, those more riskier stocks that are leading the decline after posting pretty solid gains this month. Traders perhaps happy with taking a pause after those November surges.
I decided to move my stop and profit for euro at 119.07. Right here. Okay?
Stocks falling 0.2%. Some different forces in here that continue to be the two that the UK is really focused with. We have tiers announced. London is in tier 2. That's going to be decided every 2 weeks, according to the UK's Matt Hancock. And of course, Brexit negotiations ongoing. Now, finally, Bitcoin down 8.5%. And this comes after it was just within $7 of hitting another all-time high. It continues to be volatile, but I want to jump into the charts because as Eddie Vanderwalt from MLive says, I think puts so greatly, is Bitcoin is forever the comeback kid. One characteristic of what we see Bitcoin do are these intense rallies followed by bear markets. According to Citi's Tom Fitzpatrick, that is the characteristic that will continue to define Bitcoin. So that means more gains are possible from here, and perhaps that's the way to look at it technically, because if it's driven by hopes and dreams and not fundamentals, perhaps it's that pattern we should keep looking out for, Anna.
Thank you very much, Danny. I wonder what the Bitcoin crowd are up to today, perhaps overdoing it on the turkey. Danny Berger, thank you very much for looking at the markets for us. Back to the geopolitics. China's President Xi Jinping has broken his silence on Joe Biden's election victory, sending the president-elect a message that he hopes they can manage differences. Let's discuss the future of US-China ties with Bloomberg's executive editor for international government, Ros Matheson. Ros, really good to speak to you. Many people have said that their sort of working assumption is that the US government, the new U.S. administration, doesn't necessarily about face on Chinese policy at all, but that the tone of the conversation will shift entirely and will be back to the more sort of diplomatic language of old. Does that have the power to actually make quite a big difference in this bilateral relationship?
Well, it may at least make things more predictable. I think that one of the difficult things, obviously, under the Trump administration for China was that it was very hard to get a sense of what Donald Trump might do from 1 minute to the next, and that made China perhaps a bit trigger happy, a bit overreactive from time to time. So what you might find is that if things are a bit more of an even keel, a politer kind of relationship, that it becomes more predictable and therefore less reactive. So you might see those kind of extremes of reaction perhaps diminishing. But that said, Joe Biden has every reason to be tough on China as well. In fact, he may in some areas be more so, because the Democrat Party may not hold back from criticizing China more heavily over human rights issues, for example, Xinjiang and Hong Kong and elsewhere. So you wouldn't expect it to be a warm relationship, but it may become much more predictable.
Yes, given the questions around human rights and the way the US, as you say, the Democrats like to reference that, it might be very difficult to see a rollback of some of the sanctions that have been put in place on China by the Trump administration. So I suppose we limit our expectations for change on that front.
Very much so, because you can see that Donald Trump is in fact escalating sanctions in some parts of the world on China, but also on Iran and Libya and North Korea and elsewhere. And that's to sort of scatter these landmines in a way in front of Joe Biden, because once sanctions are on, they're very difficult to remove. And you wouldn't imagine there'd be much appetite in Congress either for that to happen, because both the Democrats and the Republicans are likely to see that stronger stance on China needing to remain. So it's very difficult for Joe Biden, even if he wanted to try and unpick that, and he probably wouldn't want to waste political capital doing so. So you can imagine those sanctions regimes will continue. What you might see is perhaps a de-escalation of this kind of very endless tit-for-tat action, and in fact further retaliatory action does indeed slow down from here, because of course they need to create some space in the coming months, in the early part of the Biden administration, potentially, to have their next round of trade talks towards a phase 2 trade deal, which is going to be even more difficult, of course, than the first one.
Yeah, perhaps if we do see an end to diplomacy or lack of diplomacy by Twitter and to communications from the Chinese government via Chinese media, perhaps we do revert back to something that we understand a bit better, looks more predictable, as you suggest, Ros. What about the status of Taiwan here? This is clearly something that China views as important, that the US presidents understand the Chinese position on. Is that an area where tension could flare up still under a new administration, or will the new US administration be very careful on that front?
You could see Joe Biden potentially being a bit more careful in Taiwan than Donald Trump was. I think the Democrats really appreciate the red line that sits here for China, and we've seen Xi Jinping making very clear that he doesn't want anyone going near that red line, and in fact Beijing will crack down further if that happens. And we saw a series of high-level officials from the US coming through Taiwan in recent months. You might see Joe Biden being a little gentler on that. The Democrats, of course, have sort of long held to the view that you don't want to provoke China too much when it comes to Taiwan. There are other things to focus on. You can see, in fact, anxiety in Taiwan as a result, that the Democrats might be softer on that issue and they might feel less supported. There is that anxiety that the administration may change things for them, and they will probably in turn want to see some sort of commitment from Joe Biden to defend Taiwan if necessary. But you could see some of the heat about that issue come off the table slightly.
Yes, and as you point out, the Trump administration in its last days sanctioning further on China and Russia. Just briefly, Ros, are there things you're watching in the last month or 2 months, I suppose it is almost, under President Trump here?
Well, the big one, of course, aside from China, is Iran. You can see a very high level of concern in parts of the Middle East, Iran's opponents, that Joe Biden will come back in and try and re-energize or breathe any kind of life, indeed, into the Iranian 2015 nuclear deal that Donald Trump withdrew the US from, that he might at least crack open the door and try and resume some kind of conversation with Tehran. And you can see that there's anxiety amongst the Republicans and Donald Trump that doesn't happen, hence sanctions. And there have been these reports even that the US is considering whether they should undertake some sort of military strike on Iran before Trump leaves office, which is obviously highly a remote prospect. He's a sort of a lame duck, essentially, for the next 2 months. It'd be very odd to do so. And Saudi Arabia would be very fearful of retaliation if that happened. But certainly we need to watch Iran very closely to get a sense of what might happen then.
Thank you. Ros Matheson, thank you very much. Bloomberg's executive editor for international government. Still to come on the programme, Germany extending lockdown restrictions as the nation reports a record daily jump in new cases and virus-related deaths reach a 7-month high. We discussed the way that markets position around some of this story into the winter. Vasilis Giannakis of Banque Lombard Odier will be with us. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to this special edition of Bloomberg Markets for this Thanksgiving. European equity markets are awake, are trading. We are midway through the afternoon here, European time, and we've got the Stock 600 fairly flat, actually. The UK markets underwater, as well as the IBEX over in Spain, the banking sector, the energy sector, both heavy weights in those indexes, and so as a result, they find it difficult to move higher. Different for the CAC and the DAX, both of those in Paris and in Frankfurt, fairly flat this hour. That's a quick look at where we are on these European equity markets. US futures for equities, fairly flat actually. No trading, of course, in live markets, live cash markets today, but for what it's worth, NASDAQ futures point to the upside. Let's get a first word news update. For that, here's Leanne Gerrans. Leanne.
Hi, Anna. The Trump administration plans to keep up the pressure on Iran during its final days in power. The US sanctioned 5 companies in China and Russia for their alleged dealings with Iran's missile program. More sanctions on Iran are expected in the coming weeks, related to weapons of mass destruction and human rights. Now, it looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of US products slowed last month after hitting a high back in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. A divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice John Roberts joined the court's liberal wing in dissent. And here in the UK, Chancellor Rishi Sunak has opened up a new rift within the Conservative Party. Sunak has moved to cut the country's foreign aid budget. Some Conservatives say it's wrong to reduce spending on other countries, but the move lets Prime Minister Boris Johnson show his priorities are with the needy here at home rather than those overseas. And the AstraZeneca and the University of Oxford face more questions about their coronavirus vaccine trial results. Oxford says a manufacturing error led to later phases of the trials halving a dose given instead of a full one. That's led to the doubts that US regulators will approve the vaccine. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thanks very much for the update, Leanne. Now, sticking here in Europe, Chancellor Angela Merkel urging Germans to do more to rein in the coronavirus. With infection rates and fatalities on the rise, earlier restrictions in the nation have yielded little progress in slowing the spread of the disease. It has, according to the German Chancellor, had an impact on the sort of exponential growth, but not as much as had been intended. For more, let's bring in Bloomberg's Daniel Schaefer, who joins us now. Daniel, good to speak to you. So the most recent news flow seems to be around ski season here in Europe, which is a big deal, of course, in terms of the amount that Europeans travel. It also played an important role back in March in actually spreading the virus. So no surprise then that Chancellor Merkel finds herself focusing on that.
Yes, indeed, Anna. So this is one of the things that the regional state premiers have urged Angela Merkel to do, is that she should talk at a European level about banning the skiing season right until January 10 this year, in order to avoid such super spreader events as we've seen in Austria's Ischgl skiing resort this spring. So, but she has already said she would do it, but she said that it's going to be difficult to come to an agreement amid a lot of resistance, particularly for Austria, for which country it is. It does have a big economic impact if the skiing season would be banned.
Meanwhile, we saw meetings go late into the night, Daniel, didn't we, between Chancellor Merkel and state leaders to try and work out how the lockdown measures would be extended, and they have been extended into much of December. I say lockdown, but that doesn't really mean anything anymore, does it? I mean, I'm sitting here in London. I know that we're going to be in Tier 2 up until Christmas, and I know what I can do in London. There's no household mixing. Pubs and restaurants will shut at 11 and various other things being introduced. What will life in Germany look like then in the run-up to the festive season?
Yeah, so it looks fairly similar, actually. So basically all the restaurants, cinemas, hotels, gyms, all the leisure activities are closed, and they will remain closed through at least December 20. And one of the things that will impact the Christmas season that will be changed from December 1 is that there will be tighter rules for retail stores and shops. So they will not be allowed to let as many customers in as previously, in order to avoid too big crowds sort of doing their Christmas shopping there. Now, this has already prompted some warnings from the German Retail Association, saying that this will lead to chaos in the run-up to Christmas and huge queues in front of the shops.
Okay, that's interesting comparison. Yeah, sounds a bit more like what we understand in the UK as Tier 3. Some of the tougher regimes sound to be a bit comparable to what's going on in Germany then up to Christmas. Daniel, thank you so much. Thanks for joining us. Bloomberg's Daniel Schaefer. Joining us now with a market perspective is Vasilios Giannakis, Global Head of FX Strategy at Banque Lombard ODA. Vasilios, good to speak to you. So there's a host of factors I want to talk to you about when it comes to the euro. Let's start with when we're going to see any pushback about how strong the euro is getting from the ECB, or have we seen that already in some of the comments from Philip Lane today? The euro has actually fallen off its more recent highs. It's just over the 119 level. But are we nearing levels that start to concern the ECB, do you think?
Well, surely. We are definitely approaching levels that we've seen back in September that probed into similar comments by ECB officials. Look, the ECB is currently struggling with a really bad and deteriorating inflation outlook if you start excluding potential base effects that we're going to have next year. So it is quite likely that these voices are going to increase. It is quite likely that the ECB is going to step up verbal intervention. But one really, as far as the spot price action is concerned, has to consider how much of an impact this is going to have in the euro. And I think it is likely that it's going to curb the pace of appreciation, potentially flatten out a bit the curve around 120, 122, 123. But it will not be possible, given the exhaustion of the tools that the ECB has done so far, for the central bank to be able to sustainably talk the currency down. That would be my view.
Yes, I mean, if we did see further quantitative easing coming from the ECB, a top-up of the PEP programme, more bond buying, what kind of impact would this have on the currency? I remember recently when we saw the Bank of England announce further QE. In earlier rounds of QE, that had been currency negative, but actually this was seen as currency positive because the market, just like the citizenry, I suppose, had concluded that further support from monetary and fiscal authorities was desirable at this point, and so it sent the pound higher. So what is the link between QE and FX in Europe at this point?
Well, it's certainly not linear, and it can be different at different points in time. I mean, obviously, with ECO 101, if you increase the supply of money by the central bank, this is going to decrease the value of the exchange of your currency. But as you correctly pointed out, this time around, we've actually seen the ECB as well as the BOV and other central banks resolving into additional quantitative easing, which actually resulted into currency appreciation. And there are two things here that we have to consider. First of all, the big player in the market, the Fed, right, which has taken interest rates at zero, and therefore it has introduced a level playing field as far as interest rate differentials are concerned. The second thing is that this time around, additional quantitative easing, as you mentioned, basically removes or at least reduces at the margin the tail risk, and it's actually seen as beneficial for growth over the short to the medium term. Now, this time around, I don't expect that the euro is going to react really positively unless the ECB does quite something that surprises the market. But at the same time, I don't expect that if indeed we're going to see an expansion of the ECB's pandemic asset purchase program, that this is going to bring euro lower. I think, you know, the main factor right now of the market is really the dollar. And the dollar remains in a downside trend, and it will remain so over the next few months to a few quarters. And I think this is largely going to imply that the path for least resistance for the euro is going to remain for the upside. But at the same time, I don't think that the euro dollar is going to be the big trade in next year where we see a breakout towards 130.
Okay, and where will we see an interesting trade with the dollar in mind then, Vasilios? If you think that the dollar is going to keep falling, where is the best place to play that into 2021?
I think, to be honest with you, Anna, is that we're going to see a rotation towards more interest towards emerging market currencies, and especially Asian currencies, and especially the renminbi. Biden's victory is a game changer for the renminbi. I think it doesn't need to be elaborated any further. It just puts it into a dialogue situation between the US and China and removes the threat, basically, of additional tariffs. At the same time, what's also interesting is that by our estimates, the market has not really priced in any reduction, and at least an immediate reduction in tariffs. We don't expect that it's going to happen over the next few months, but there is a risk. And if that manifests and materializes, then dollar-China could actually drop significantly more than we currently expect. We currently forecast 6.40 in about 12 months' time, but I think the risk is to the downside.
Okay, so we'll watch that with interest and not expect too much in terms of rollback of tariffs then, perhaps. Vasilios, on the pound, we've heard from Ursula von der Leyen. We also heard from the Irish foreign minister today, both of them emphasising the importance of the coming days. It sounded quite short-term, the language. I wonder what your expectation is. It feels like we've been to the cliff edge on Brexit a few times.
Well, the reality of it, Anna, is that how important are crucial the next few hours, the next few days, and the next few weeks are, I have kept hearing for the past 4 or 5 years, and that's the reality of it. I think we need to start cutting through the noise and try to establish a central view here. And I think both sides have made progress. They have converged even in the thorny issues of fisheries and of the level playing field. As far as we're concerned, really, the important thing is how cleverly they will draft the agreement in a way that they can actually sell it politically to their internal audience as a political success for its side. So personally, I think we are already positioned for a basic Brexit deal. A lot of the things will be kicked down the road. And I think cable is going to rise from here alongside the dollar downside. But I wouldn't chase cable higher really than above 137, 138, because we have to remember there are going to be a number of structural headwinds in the UK economy because of Brexit. And at the same time, the country is struggling with a huge debt burden.
Okay, thank you so much, Vasilios Giannakis of Bonclobard ODA. Just on the subject of Brexit, we're just getting some lines coming through from the UK Prime Minister's spokesman, Jamie Davies, briefing reporters, saying the UK is keen to intensify talks and reach a deal with the EU. It's up to the EU to decide if they travel to the UK for Brexit talks. This has been after reports have suggested that perhaps the French delegation didn't see that there was a point in travelling. Such was the lack of progress in their view. Coming up on the programme, with the US election behind us and 3 promising vaccines on the table, investors are positioning for what's next. We discuss how to manage stocks and bonds in a low-yield era with Barry Ritholtz of Ritholtz Wealth Management. He's also been reflecting on how we best use the time between now and when, maybe spring, summer next year, to live better lives. We'll talk to him a little bit about what he's been doing to use the time that COVID has afforded him. Barry Ritholtz joins us next for our next conversation here on Bloomberg Markets this Thanksgiving. Special edition of the programme because of that Thanksgiving holiday. Of course, European equity markets going exactly nowhere this hour. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to this special edition of Bloomberg Markets. Then for this Thanksgiving, investors have been focused on equities in the post-US election pre-COVID vaccine period of time. But Bloomberg opinion columnist Barry Ritholtz writes it's a mistake to overlook the fixed income part of their portfolios. To explain why, we welcome Barry Ritholtz, chairman and CIO of Ritholtz Wealth Management. He's also the host of Bloomberg's Masters in Business podcast. Great to speak to you. Happy Thanksgiving to you, Barry. Thank you very much for joining us on this special edition. Let me ask you about your thoughts then on the reasons to hold bonds at this moment. We were talking to a guest earlier on this program, Alberto Gallo, was saying that he doesn't want to hold bonds. He doesn't want to hold sovereign debt anyway at this point. He doesn't see the reason to. What is the argument for holding it right now?
Well, I don't necessarily disagree with him. The issue is, what are your alternatives? And people seem to forget that bonds serve two purposes in a portfolio. One is yield, but the other purpose is to act as a volatility dampener. And it was much easier to ride out the February-March 34% sell-off in equities in the U.S. if you weren't 100% equities, if you had some cushion. And typically, that's a 70-30 or a 60-40 split between stocks and bonds. Doesn't mean you should be all treasuries and certainly not the longer duration ones, but you need some ballast in your portfolio to offset the volatility of equities.
Does it provide that diversification that people searched for? Is that part of the reason to hold treasuries, or should we not look at them for that? I mean, so many things seem to be correlated these days.
Right. Well, look what just happened in March in the middle of that sell-off. Stocks plummeted. Even things like preferred stocks fell just about as much as equities, but bonds held their own and did better. It becomes a safe harbor. By the way, you don't have to only hold long-term treasuries. High-quality corporates are yielding significantly higher than the 10-year. You also can look at things like municipal bonds that have a higher after-tax yield. And if you feel like you can manage your own behavior, you could shorten your duration in your portfolio, hold 3-month notes instead of 10-year notes, and allow yields to eventually return to normal with the plan of rolling out of 10% of those shorter duration holdings every couple of years as rates rise. The best solution is a bond yield ladder, but that takes a decent amount of cash, and not every portfolio is going to be able to do that.
And every investor has their own sort of risk tolerance, don't they, Barry? And I suppose you've got to keep that in mind when we hear investors talk about going up the risk spectrum and deciding to take on more risk to see if they can find more yield. Are you having a lot of conversations with people about that at the moment?
Well, we spend a lot of time educating clients on the fact that stocks go up and down, and that it's a feature, not a bug. The reason you get a reward in equities is because there's risk involved, and there are years where you're going to see substantial pullbacks, 5% just about every year, 10% every other year. Something like 30% drop like we saw in 2020 comes along much more frequently than people realize. And I've heard a number of people advocate for a 100% equity portfolio. I mean, if you're 25 and you have a 50-year time horizon and you're not going to open your statement each month and freak out, sure. Although if you're a 25-year-old, you're on Robinhood and getting updates every tick. But if you have the ability to ignore the ups and downs, you can bump up your equity exposure a few percent. 60-40 becomes 65-35. But I wouldn't go from 60-40 to 90-10. You're going to have a hard time managing yourself the next time we see 20 or a 40% drop.
Okay. A good time to have this conversation, and as interesting as it is, Barry, to talk about this, I was really interested in your blog, reading your blog post on how, in your assessment, we're in the midpoints of this changed lifestyle we are all enjoying around the pandemic, and the way that people should think about spending their time. When you reflect on what you've done with the last 7 or 8 months, Barry, and what you'll do with the ones still to come, are you making changes?
Yeah, I've done a number of things. Look, if the lockdown dates to March and best estimates of the 3 different vaccines being distributed in some form of herd immunity is June, we're just about the halfway point, which is kind of horrifying to think about. But, you know, a good part of financial planning is the ability to project yourself forward and imagine how you're going to feel when you're looking back. And that June date made me stop and think, what am I going to wish I did starting now so that after the next 8 months, I have something to show for it beyond, you know, being sick to death of the same 4 walls and walking the same few miles of trails around where I live. So I have friends who want to learn to play guitar, want to learn a different language. I'm a little bit of, I'm pretty handy in a kitchen, but I'd really like to learn how to be a better chef. So I've started taking some, reading some books and taking some classes with that. Same with some classes I took in college on astrophysics that always intrigued me. I've been doing more and more of that. The list is endless of the things you can do in terms of what do you want to have to show for your 16 months of lockdown. Hopefully it's more than just boredom with where you live and some minor changes you've made around the edges.
Barry, my piano's getting a little better. It wasn't very good to start with, but you know, it's all at the margin, isn't it? And I've seen a number of our guests who we normally talk to about financial markets posting, you know, on various social media platforms, them performing music and that being something of an escape. I suppose it's whatever makes you happy. How's the book coming along?
Well, you could see the cards on the wall behind me is a method of structuring I stole from Ryan Holiday. But, you know, it's slow and steady progress. You have to make a concerted effort to set time aside to do the things you want to do. And all of us who normally would be commuting anywhere from 10 to 20 hours a week, that's found time that could best be put to work with it. It's very easy to get lost on Twitter and social media and online distractions. I'm building a number of breaks within my day to make sure I don't fall into that rabbit hole. And I just keep trying to iterate my calendar, my schedule, and get better at both managing my work time, my play time, and my, you know, self-improvement and learning time.
Barry, thank you so much for your time. Good to speak to you. Walking, that's my new rediscovery. Barry Rittles of Rittles Wealth Management. Thank you so much for joining us. Really good to speak to you today. And happy Thanksgiving to you and yours. Coming up on Bloomberg Television, Nomura FX strategist Jordan Rochester will be joining us. Lots to talk to him about. A live shot of New York for you now. The annual Macy's Thanksgiving Day Parade is due to get underway shortly. It is like many things this year. It will look very different. It's a virtual parade in 2020 with performances in a closed set outside the flagship Manhattan store. Not quite the Thanksgiving you're used to, but still, this is Bloomberg.
Side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that is even more difficult to control than the technology of the period then.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
PM in London, 9 a.m. in New York. From London, I'm Guy Johnson. U.S. equity and bond markets are, of course, closed for Thanksgiving in the United States. Happy Thanksgiving. Welcome to Bloomberg Markets. Let's talk about what is happening. Markets-wise, light volume is certainly a theme, but nevertheless, some interesting narratives developing. European stocks basically just going sideways. We're seeing a similar story in the SPOOs as well, so S&P futures basically doing nothing right now. But elsewhere, the story is starting to get a little bit more interesting. Euro-dollar at 119. Are we starting to approach levels where the ECB is going to be concerned about what is happening with the currency? We've had ECB accounts today, some indications from Philip Lane that he's getting concerned about what lending conditions are looking like. Does that up the ante in terms of what we can expect come December from the ECB? Then we take a look at what is happening with Bitcoin. A huge reversal continues. 17,000 now the price. Is there going to be a ripple across into stories such as Tesla, other speculative bubbles, some would say? We will watch all of these stories with interest and great coverage coming up over the next 3 hours. The virus, though, remains front and center. Europe continues to grapple with the pandemic. Germany is extending its partial shutdown to at least December the 20th as it sees a record increase in new cases. Joining us now with all the details, Bloomberg's Emma Chandra.
Thanks very much, Guy. Yes, you mentioned Germany there, and we're seeing more than 32,600 new cases in the last 24 hours in Germany, and that is a record increase. We've seen the number of new cases triple since the start of October, and that's bringing total cases in Germany close to 1 million. And that's why we're seeing this extension of the partial lockdown in Germany until at least December the 20th. If you look at the rest of Europe, though, Guy, we are seeing a bit more of a nuanced story. We've got a Bloomberg terminal chart that will show you new cases among the major nations in Europe. I'm talking of the likes of Italy, France, Spain, Great Britain, and of course Germany. And what we're seeing there is that while those cases have surged through the end of October and through November, a lot of those are tailing off in the likes of France, Great Britain, Italy, and Spain. And therefore, we're starting to see those countries change their lockdown measures, perhaps easing some restrictions as we head towards Christmas.
Emma, thanks very much indeed. Emma Chandra on what is happening with the virus story. The question we're all asking ourselves now is, as we approach Thanksgiving, as we look at what is going to happen with Thanksgiving, are we going to see an uptick in the United States as people get together? We are seeing some loosening of restrictions here in Europe as we approach Christmas as well. Are we going to see a similar thing over here in Europe? And if so, what is the playbook? Jordan Rochester, Nomura FX strategist, joining us now to discuss this and plenty of other issues. Jordan, if we do see this uptick and numbers are already elevated in the United States, what is the playbook?
Well, Guy, the playbook is don't overreact. Unfortunately, what's happening in the real world is different to what happens in markets. For us, what we need to consider is, does this pickup in virus cases lead to a change in the current playbook, which is central banks are easing monetary policy, they're keeping financial conditions loose, and the fiscal policy keeps on pumping out. That won't change if virus cases go up. In fact, what that means is good news for equity markets, it's good news for risk sentiment, Guy. If you have virus cases going up and lockdowns being needed, it will lead to the Fed striking a more dovish tone in December. It could lead to the ECB also being dovish as well. The question we have to ask ourselves, this would change the playbook, I think, when it comes to currencies, is does it lead to rate cuts? Because we had the Fed cut rates much earlier on this year. The ECB avoided that. They didn't cut rates. And the playbook would change if in December they were to look at the virus numbers, look at the impact it's having, and decide the best step forward is both quantitative easing in the form of their pandemic emergency purchase program and a rate cut. Now, the jury is a bit undecided as to whether the ECB will do that. The market's not really thinking it's going to happen. If it does, then it does change the playbook for the likes of the euro. It would start to weaken. I think really, though, I've got all my medium to long-term charts, Guy, which say with a vaccine on the way, now's the time to be long the euro. It's the time to be long those countries that have underperformed during this crisis as well. A country that is overexposed to leisure and tourism and travel is going to be on people's minds when it comes to what's the trade for next year when vaccines get rolled out. We just have to get through this winter. And it's how long investors can ignore that virus data, Guy, and look to the future. Because you're right, with Thanksgiving, the risk is we have a massive spike in US cases. I think the UK provides a good example. Well, last time I spoke to you, Guy, was actually the day before we went into lockdown, and we kind of called it a last hurrah. I mean, I had a restaurant table booked for that Wednesday before we went into lockdown, and it was actually one of the most busiest open table days in the year. Even versus last year, it was up 40%. So the day before lockdown, everybody went for a dinner if they could, and we actually saw that impact feed through to the data, Guy. We saw around 30,000 cases or so in the UK on a single day. The main point from that lesson is it came off thanks to the lockdown itself, and the numbers have started to fall in terms of cases, at least for the UK. The question will be, will that be the same for the US? Will lockdowns be rolled out after Thanksgiving to reduce the spread of the virus? It's an open question.
Yeah, we will certainly see. It will be done on a state-by-state basis. It certainly seems at the moment, and we do have this patchwork operating across the United States. Let's talk a bit about some of the other issues you've raised in there. I want to start off with the ECB, so let's kind of pick this all apart. We had the accounts a little bit earlier on. Philip Lane, though, is talking about the fact that financial conditions are starting to tighten in the Eurozone, and he may be the canary in the coal mine in terms of exactly what you've just discussed, the possibility that we do get more from the ECB in a few days' time, week after next, and we start thinking about a wider range of assets being used at that point. And Lagarde has talked about this. Jordan, how high do you think the barrier is for the ECB to get over to have to achieve that? Because Lane's already talking about it now.
Yeah, you've also got a stronger currency feeding through to that. The credit lending conditions, they're still supportive, but there's been some tightening in terms of the amount of credit given to households and firms and the standards being attached to that. And that's really important. What we don't want is for the credit channel to tighten up, especially with a vaccine in the pipeline. It would just be really unfortunate if, just as things start to look better, that we see a tightening in conditions that leads to a scarring, a permanent scarring to the economy. The idea is to hope for a V shape and at least get a U shape if we can. And so that's why, for this time being, governments have stepped in. And when it comes to the ECB, that's the point. Their quantitative easing, their PEP, their Pandemic Emergency Purchase Program, it's so powerful. Look at the like of the peripheral spreads, Italy and Spain and so forth. their sort of spread markets have tightened to the bund, allowing the sort of typical trades during a recession you typically have credit spreads widen. And that hasn't happened in this recession thanks to the actions of policymakers. So the ECB needs to make sure PEP is stepped up. And they've really spoken about that. Like in the speeches Lagarde made recently, the focus has been on PEP, and it's been on the bank lending channel via TLTROs. Rate cuts are there, and rate cuts tend to get talked about when we approach 120 in Eurodollar, and here we are at 119. But the main thing I'd point out is that the euro versus the dollar, it has strengthened. But actually, versus the likes of China, its biggest trade partner, 22% of all European trade is with China. It hasn't strengthened that much at all. The CNH has also been outperforming. It's just reflective of the broad dollar weakness. So I think, Guy, the market's not too convinced December is going to be a rate cut. You had my colleague George Buckley on earlier. He's got a rate cut penciled in for that meeting. If it happens, it does mean euro comes off quite a bit, as it will be a shock to the system. But what would be the question I would have is this a one and done, or is this a series of rate cuts to come? And if it does happen, it's probably more likely to be a one and done, with next year going to be the reopening trade and back to normal trade, where central banks won't need to be cutting rates. They'll just be here to make sure that fiscal can continue and have a lot of QE.
Jordan, final quick question. Crude down a touch today. NOKI's been a huge beneficiary over the last few days. How much more is there in that trade?
Well, the problem with oil is OPEC's going to try and manage the supply side here. And so with the return to normal trade next year, the normalization trade, I would be optimistic on energy. I would be optimistic on the likes of CAD and NOKI. It's just how much demand picks up versus the supply that OPEC will be giving. For the time being, OPEC will be trying to make sure prices stay sustained. So I'm pretty optimistic, Guy, on the likes of NOKI. I think NOKI could be one of the outperformers of next year. It's already outperformed this year. But in terms of the return to normal trade, I've got to look at the likes of Aussie, Kiwi, CAD, NOKI. Those high beta currencies will probably be the ones that investors look at. A lot of us are really just looking at what happened in 2009. And you had the big commodities boom. And the question is, does that happen? I'm not going to call for a big commodities boom, but it's at least going to be in one direction, which is slowly drifting higher. So the likes of those currencies, I think, should outperform next year.
Jordan, stick around. We still need to talk about Brexit. Can't believe we've got this far without mentioning it. We'll be there soon. Jordan sticking around. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
12 minutes past the hour, live from London. I'm Guy Johnson. This is Bloomberg Markets. Let's talk about UK assets and what is happening with Brexit, the pound, and everything else. Here with the details, Danny Berger.
Guy, well, just a quick look at what's happening in UK markets today. You can see they're absolutely underperforming the Stock 600, and really is a story of what we've seen over the past few months. And that's this confluence of factors for the region, not just COVID, but of course, Brexit concerns as well. We had seen the pound do better over recent days, over the past week, really with speculation that we're getting closer to a deal today. And overnight, the French foreign minister says that the UK is dragging its feet, unclear whether that deal will be reached, what progress it is making. So we're seeing the pound decline, but this is reversing a couple days of gains, about 4 days of gains. So yes, it's down 0.3%, but there's not a lot of volume. And what that gives us is a picture of divergence. And I want to dive into the charts for this because the pound floating around a 3-month high, again, despite the fact that we've seen it decline. Here it is in blue. So you can see it continues to do well. But as Nordea, Sebastian Gailey says, that there is perhaps not enough risk priced into the pound. You can see that happening underneath the surface. Here's what risk reversals are doing. 1 week risk reversals now at their most bearish since September. So investors perhaps pricing in that things are not as sunny as the cash markets are saying, perhaps gearing up for any sort of hedging because the cash market is higher. But really, more investors are saying any temporary boost we get from a deal will likely be followed by a drag lower in the pound as coronavirus continues to hurt the economy, Guy.
Danny, thanks very much indeed. Danny Berger setting up very nicely our next conversation. Still with us, Jordan Rochester of Nomura. Jordan, is cash not pricing enough when it comes to the downside? The UK economy is taking a beating right now. Brexit, the risk of a no deal still lingers. Are we really pricing that in at 133?
I think Danny summed up really well there, Guy. First of all, if I look at the futures positioning data, the market isn't really long sterling at all. It's actually net short, a very small amount, around half a billion or something like that. But the numbers are really tiny. Why? Because a lot of people have just said, you know what, I don't have a good idea what Brexit's going to mean into this year end. Let's not have too much risk in this. So the spec market, the speculative market, is actually playing this very lightly. It's why you've seen that drift higher in cable, as that chart just showed you, but 1 week risk reversals, which is hedging for the 1 week downside in cable, has been picking up. I think, Guy, if you look at the spreads as well, we look at 26 different UK assets from rates, credit, equities, and FX. There is a premium priced in for Brexit. So the trade we've had on, actually, I've got long cable on, looking for sort of 135 levels on a deal being done to 136. That's the sort of targets I have in mind in the short term. And bear in mind, we're talking about cable as well. And we've got a very strong view that the dollar should weaken in the medium term as well. So that should drift cable higher along with it, thanks to what the euro's doing too. So you've got risk priced in. It's just not as crazy as it has been in previous hard Brexit episodes. Why is that, Guy? It's because we're so used to the trade deal or the necessary steps being made at the very last second to avoid that cliff edge. Now, Boris already threatened a hard Brexit several times, more recently in October, I believe. The market shrugged it off. And why is that? It's because the base case remains a skinny free trade agreement. It's not a game changer. The City of London loses passporting. So it's a small positive, and in the long term makes very little difference versus a hard Brexit, according to some models. So, Guy, view from us is the deal should be done. It's just frustratingly boring when it will happen. Will it be this week? Will it be next week? And the front end of FX markets has to deal with that. But I do agree with the comment from Danny there. Yes, it doesn't look like it from cash markets that enough risk is priced in the short term. But the problem is we've just had 4 years of this. The market's just got to grow a thick skin to all of this sort of political drama and focus on the base case, which is dollar weakness and a deal hopefully done with Brexit in the medium term.
Okay, a couple of things in there. First of all, would you fade that move to 136? And do you think there is a setup now that is growing for a counter-cyclical short-term rally in the dollar?
Well, okay, so if we have the deal, I said for a while that when we get the deal, it will be a buy the rumor, sell the fat moment. So you'll have sterling go up, it will trade sideways for a few days, and then actually start to drift lower. Looking at the situation with the US, with the sort of split Congress we've got, in terms of the balance of payments from the US and the lack of Fed QE mopping up that excess treasury issuance, it's actually really hard for the dollar to rally. And that's why with cable, it's kind of a tricky one to be bearish on the pound with. If you want to have a clearer investment outlook, for me, it is the euro. So perhaps the buy the rumor, sell the fact trade is not in cable. It's more of a euro sterling sort of trade. And then if you really want to get clever about it, it's looking at those currencies I spoke about earlier. So if we have the return to normal trade next year, you'll see commodity currencies do well. And Guy, think about it. Which country has had the biggest hit to its economy, in the G10 at least, from this crisis? The answer is where we're sat right now, in the UK. So it's also going to be one of the countries that people look at as the return to normal trade, even though it's got Brexit, which won't be normal, in the background. So it's definitely a mixed picture there. Going to your dollar question, there's only really one chart I can show you that suggests you should buy the dollar, which is positioning. It's everyone's favorite consensus trade, short the dollar. So typically it leads to these position squeezes. We saw it earlier this week. Euro went from 119 nearly down to 118. It was a big move just within a matter of a few minutes. You're going to see more price action like that. But again, I've got about 40 charts telling you to buy euro dollar, and I've got just that one chart, which is speculative positioning. But remember, in FX, the speculative market is actually the most insignificant part of it. There's the real money flows from corporates, the trade flows, the balance of payments, the central bank data to follow as well. And all of that shows continued dollar selling in the new year. We just got to deal with this speculative market that's got overly exposed to it. So we're going to see a rotation out of euro into those higher beta trades, I think, in the new year.
Jordan, what's your view on Bitcoin?
I don't have an official view. I did hold it back when everyone really found it exciting, but I've just since then just hands off. Not for me to mess around with. The vol's too high. 9% in a day. It's not for me.
It is a little whippy. I think that probably is an understatement. Jordan, thank you very much. Yeah, thanks very much indeed. Jordan Rochester of Nomura joining us. We'll talk more about what is happening in the UK a little bit later on the programme. We're going to be joined by Sir Charlie Bean from the OBR to get his take. This is Bloomberg.
Goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonizes it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
Happy Thanksgiving. Time for Bloomberg Business Flash. Let's take a look at some of the biggest business stories that we are watching right now. Disney has announced 4,000 more job cuts after virus lockdowns forced the closure of its theme parks. That takes the number of layoffs set for the first 6 months of the year next year to 32,000. That's more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses like studios, parks, and cruises. Bloomberg has learned that Foxconn will move the manufacturing of some Apple iPads and MacBooks from China to Vietnam. The company is trying to mitigate the risks that a trade war between China and the US may continue after Donald Trump leaves the White House. Apple's partners have already ramped up iPhone production in India. And AstraZeneca and the University of Oxford are facing more questions about their coronavirus vaccine trial results. Oxford says a manufacturing error led to some participants getting the half dose instead of the full one. And that's your Bloomberg Business Flash. Now, let's take a look at the future of European banking. Bloomberg's Francine Lacroix spoke to BNP's chairman, Jean Lemierre, a little earlier on today. She started by asking him the big question for European banks, and that is, when will they be able to restart paying dividends?
Of course, shareholders do wish to have a dividend. This is normal. They allocate capital to the bank. We use the capital they put in the bank, and they want to be rewarded if it is possible. I think the decision made, the recommendation given by the ECB has been broadly well understood at springtime. There was a high level of uncertainty. Nobody knew exactly what was going to happen. And even if it came as a big negative surprise, it was part of the negative news out of the COVID crisis. But to a large extent, investors, of course, are not positive, not happy, but I think most of them have understood. You see what I mean? The question is the decision which is going to be made by the ECB, the recommendation they will give in December. I think today we are still in difficulties. Let's be clear, there is a second wave of contagion everywhere in Europe and in the world. There are difficulties, lockdown is still there, and the reopening of the business is moving forward, but there are still many difficulties. So I think there's still a level of difficulties, but I think there's more certainty. I think we understand better what's going to happen. We understand better the risk ahead. We understand better the challenges we have, and in the dialogue with the supervisor is about these questions. So I hope that this understanding will help the decision-making by the ECB about the recommendation they will give in December.
Do markets have to be less exuberant, given we're not exactly sure when a good chunk of the population will be vaccinated?
Yes, once more on the vaccine, I think there is light at the end of the tunnel. I'm very confident scientists are developing vaccines and medicines which are going to help a lot people to go through this virus crisis. So there will be one. Now, we know there are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time, but at least there is a light, and that's what is very important. I think this is well understood by the market.
The chairman of BNP Paribas speaking exclusively to Francine Lacroix a little bit earlier on. This is Bloomberg.
Können Sie einmal noch ganz kurz zu uns kommen? Ganz kurz.
Davor stellen.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From London, I'm Guy Johnson. This is Bloomberg Markets. Let's check in on the Bloomberg First Word News. In the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed in Tier 2. That means pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be able to mix indoors. It looks as though China won't meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of US products slowed last month after hitting a high in September. As of the end of October, China had bought only 44% of this year's target of $172 billion worth of American goods. And a divided US Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. Cuomo wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice John Roberts joined the court's liberal wing in dissent. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 127 countries. Let's keep the focus on the coronavirus crisis. US authorities say airline passenger numbers reached their highest point since mid-March as Americans fly for the Thanksgiving holiday. All that travel could, of course, worsen the pandemic. Joining us now, Hamish Adolja, Johns Hopkins Center for Health Security senior scholar. Good morning, and thanks for joining us on Thanksgiving. What is your expectation in terms of the uptick that we could see in case counts in the United States as a result of all this travel and gathering we're going to see today on Thanksgiving?
Based upon what we're seeing with airports, with travel patterns, with mobility, and people's desire to get together with their families, I think it's inevitable that we'll see a significant uptick, maybe 10, 14 days after this, which will end up leading to more hospitalizations and more hospitals worrying about capacity. I think we saw, if you look at the Canadian Thanksgiving about a month ago, the same type of phenomenon occur. And I do think that we will have that same scenario in the United States in a system that's already feeling a lot of stresses from COVID patients.